right, welcome back to the program. In case you're just tuning in, this is Moneyline with Nancy, and I am Nancy Naji. We will be taking you through the World Economic Outlook report in a bit, but what the IMF has said so far is that the baseline forecast is for growth to fall from 3.4% in 2022 to about 2.8% in 2023 before settling at 3% in 2024. And advanced economies are expected to see an especially pronounced growth slowdown from about 2.7% in 2022 to 1.3% in 2023. Of course, we've seen 3 years of COVID. We've seen the cost of living crisis across the world. We've actually also seen high inflation and financial turmoil, especially in advanced countries like the United States as well as Switzerland. Let's quickly take you through the session, and we will be right back.
The global economy remains on track for a gradual recovery from the pandemic and Russia's war on Ukraine. China's reopened economy is rebounding strongly. Supply chain disruptions are unwinding, while the dislocations to energy and food markets caused by the war are receding. The massive and synchronized tightening of monetary policy by most central banks is starting to bring inflation back towards its targets. At the same time, serious financial stability-related downside risks have emerged. In our latest forecast, global growth will bottom out at 2.8% this year, before rising modestly to 3% next year, almost unchanged from our January projections. Global inflation will ease, although more slowly than initially anticipated, from 8.7% last year to 7% this year and 4.9% next year. This year's slowdown is concentrated in advanced economies, where growth is expected to fall to 1.3% this year, before increasing modestly next year. By contrast, emerging market and developing economies are already pushing ahead in many cases, with year-end growth accelerating to 4.5% this year from 2.8% last year. The recent banking instability reminds us, however, that the situation remains fragile. Once again, downside risks dominate. First, inflation is much stickier than anticipated, even a few months ago. While global inflation has declined, this reflects mostly the sharp reversal in energy and food prices. But core inflation, excluding energy and food prices, has still not peaked in many countries. It is expected to decline to 6.2% this year, still well above target. Activity too shows signs of resilience. At this point in the tightening cycle, we would expect to see more signs of output and employment softening. Instead, both output and inflation estimates have been revised upwards for the last 2 quarters, suggesting stronger than expected global demand. This may call for monetary policy to tighten further or to stay tighter for longer than currently anticipated. There is little evidence of an uncontrolled wage price spiral. Nominal wage inflation continues to lag price inflation, implying a decline in real wages. But labor markets are still very tight in many countries. This suggests real wages should increase, and we expect they will. Corporate margins have surged in recent years. This is the flip side of steeply higher prices, but only modestly higher wages, and should be able to absorb much of the rising labor costs on average. As long as inflation expectations remain well anchored, as they are now, that process should not spin out of control. More worrisome are the side effects that the sharp policy tightening of the last 12 months is starting to have on the financial sector. We have repeatedly warned this would not be an easy ride. Following a prolonged period of muted inflation and low interest rates, the financial sector had become too complacent towards maturity and liquidity mismatches. Last year's rapid policy tightening triggered sizable losses on long-term fixed income assets and increased bank funding costs. The brief instability last fall in the United Kingdom's gilt market and the recent banking turbulence in the United States illustrate instead that significant vulnerabilities do exist, both among banks and non-bank financial institutions. In both cases, financial and monetary authorities took quick and strong action, and so far have prevented further instability. Broader markets have remained calm, and volatility has been contained, including for emerging and developing economies. Increasing funding costs and the need to act more prudently, however, may push banks to cut down lending further. In our World Economic Outlook, we explore such a scenario and find that it would lead to an additional 0.3% reduction in output this year. Yet, the financial system may well be tested even more. Nervous investors often look for the next weakest link, as they did with Credit Suisse, a globally systemic but ailing European bank. Financial institutions with excess leverage, credit risk, or interest rate exposure, too much dependence on short-term funding, or located in jurisdictions with limited fiscal space could become the next target. So could countries with weaker perceived fundamentals. A sharp tightening of global financial conditions, which is sometimes called a risk-off event, would have a dramatic impact on credit conditions and public finances, especially in emerging market and developing economies. It would precipitate large capital outflows, a sudden increase in risk premia, a dollar appreciation in a rush towards safety, and major declines in global activity amid lower confidence. In such a severe downside scenario, global growth this year could fall to about 1%, an outcome whose probability we estimate at about 15%. We are therefore entering a tricky phase during which economic growth remains low by historical standards, financial risks have increased, yet inflation has not decisively turned the corner. Policymakers will need a steady hand and clear communication. First, with financial instability contained, monetary policy should remain focused on bringing inflation down, but stand ready to adjust promptly as financial developments might demand. A silver lining is that the contraction in bank lending could partially mitigate the need for further monetary policy tightening. But any expectation that central banks will prematurely surrender the inflation fight would have the opposite effect, lowering yields, supporting activity beyond what is warranted, and ultimately complicating the task of central banks. Fiscal policy can also play an active role. By cooling off economic activity, a tighter fiscal policy would support monetary objectives. Appropriately designed fiscal consolidations can help rebuild much-needed fiscal buffers and help strengthen financial stability, something that we explore in Chapter 3 of our World Economic Outlook. While fiscal policy is turning less expansionary in many countries this year, more could be done to regain fiscal space. Regulators and supervisors should strengthen oversight to ensure any remaining financial fragilities don't morph into a full-blown financial crisis. For emerging market and developing economies, this also means ensuring proper access to the global financial safety net, including the IMF's precautionary arrangements, access to central bank swap lines where relevant, and foreign exchange reserves. Exchange rates should be allowed to adjust as much as possible, unless doing so raises financial stability risks or threatens price stability, in line with our integrated policy framework. Our latest projections also indicate an overall slowdown in medium-term growth forecasts. 5-year ahead growth projections declined steadily from 4.9% in 2011 to 3% this year. Some of this decline is predictable. Growth slows as countries converge. But some of the more recent slowdown may also reflect more ominous forces: the scarring impact of the pandemic, a slower pace of structural reforms, as well as the rising and increasingly real threat of geo-economic fragmentation, leading to more trade tensions, less direct investment, and a slower pace of technology adoption and innovation across fragmented blocs. Fragmented world is unlikely to achieve progress for all or to successfully tackle global challenges such as climate change or pandemic preparedness. We must avoid that path at all costs. Thank you. So let me say a few words about sub-Saharan Africa, and then I will ask Daniel to come in on Nigeria and South Africa more specifically. So very clearly, the region is suffering from a strong funding squeeze that we already discussed. I mean, some of the countries that are facing very elevated spreads. A lot of them are in the region. A lot of the challenges come from external factors, the surge in energy prices and food prices as a consequence of the Russian invasion of Ukraine and the tension on energy markets is affecting the region. So we have a slowing growth for the region overall to about 3.6% in 2023 from 3.9% last year. We also have a situation where inflation is elevated. It's double-digit inflation, expected to come down from 16%, roughly 16%, to about 12.3%, but still double-digit inflation. And of course, a very important challenge for the region is as a result of these elevated food prices, we have a large number of people who are in situations of food insecurities. We estimate about something like 130 million people in situation of food insecurity. Daniel.
Thank you. For Nigeria, our forecast is one of the most stable ones for this year. We have a slight increase. We have 3.3% in 2022. That's an upward revision. And for 2023, about the same, 3.23% in 2024. So this is an economy with very high inflation as well. And this is why we have a forecast of about 20% for 2023. And one of our main recommendations is to tighten the monetary policy to ensure that this inflation comes down towards the more target levels. So that's for Nigeria. For South Africa, this is an economy where we have a sharp slowdown to about 0.1% growth this year. That's a minus 1.1 percentage point revision, and this mainly reflects the much more severe than expected outages in the energy sector, especially in the last quarter of 2022. But next year we expect more power to come online and the growth to recover to 1.8%. More renewable power in particular should be connected. On the inflation front, the inflation is forecasted to come down to inside the target range of the South Africa Reserve Bank, 5.8% in 2023, and then continue coming down 4.8%. So we did welcome the recent increase in interest rates to 7.75%. That is why we expect inflation to converge to the target.
So on China, we have, of course, this is one of the bright news for 2023. The rapid reopening of the economy is leading to a strong rebound. So we're projecting 5.2% growth in 2023. That's up from 3% last year. So very clearly, very significant effect. And of course, still some slack in the Chinese economy. So inflation pressures remain quite modest, and we anticipate that there will be mostly around 2% this year and next year, increasing a little bit, maybe next year 2.2%. One of the risks looking ahead for the Chinese economy is, of course, the property sector. There's been some concerns already expressed, last year in terms of the extent to which the property sector might weigh down on growth, given the weakness we see there. And there are a number of measures that have been implemented, but more could be done to make sure that this sector stops contracting and doesn't drag down growth in China going ahead. There is also some discussion about the extent to which the Chinese reopening leads to a surge in consumption. So far, that seems to be there, but it's not maybe as strong as we've seen in other countries. So there still may be a little bit of a prudent behavior on the part of households and consumption. But this is certainly something that is contributing overall. The reopening is contributing to global growth with positive spillovers. Daniel, anything to add on China?
Only about those spillovers that so far in the region we haven't seen as big an impact as we might have expected in the past from such a strong Chinese rebound. And one of the reasons that this is growth rebound that is more concentrated in the domestic services than in the past, where it was more investment-led. And so that has a smaller impact. And also our medium-term forecast for China is moderating. So that also means less positive spillovers to other countries around the world.
Egypt is indeed facing a very challenging outlook, like many other countries across the world, and we have downgraded the forecast for this year by 0.3 and by 0.3 also for the coming year. And part of that, the lower growth in this difficult environment is related to the external environment and the very high financing costs that Egypt is facing. At the same time, we've also seen the depreciation of the currency and its impact on the economy, as well as the continued backlog of imports, as well as rationing of FX. So all of these factors have lowered business and consumer confidence, and that is what is underpinning this lower growth this year and next. All of that being said, we're still talking about growth being at 3.7 this year and 5 in 2024. And when it comes to the engagement on policies, as you know, indeed, Egypt is being supported by a fund program, and there is preparation right now for the first review of the EFF. Thank you.
Well, so we do explore, as you point out, in our report, both we have a baseline scenario, then we have a plausible alternative scenario where we take into account the contraction in bank lending that could be coming as a consequence of the financial turbulence we had in the last month. And then we have a more extreme scenario where we try to quantify what would be the effect of a full risk-off event with a large impact, especially on emerging market and developing economies. To answer your question, when we do the assessment of the probability distribution, if you want, of the outcomes, we find that reaching something like a 1% growth rate for global output, which would be a very, very low growth rate by historical standards, something that we've only had maybe 5 times in the last 40 years or so, has a probability of about 15%. So that gives you a sense of the likelihood, if you want. But more broadly, the point I want to make here is that we've had some turbulence in the last month, and authorities have responded very strongly, very forcefully. Some lessons have clearly been learned from the global financial crisis. And also, we should point out that the banking system in particular is in much better health overall, even if there are pockets of instability, than it was 15 years ago. So all of these are good things, and they've been useful in helping to contain the risks that we are facing. But we do recognize that there is a certain amount of nervousness in the markets right now, that there are maybe some lurking vulnerabilities, and this is why it's very important at this point for financial supervisors, regulators, authorities to really go and look very carefully at those pockets of vulnerability that might still exist, whether in the banking sector, in the non-bank financial institutions, and more broadly. I think the way I would articulate it, and the way we articulate it in our World Economic Outlook, is that our assessment at this point is that the financial risks appear reasonably well contained. And given that they're reasonably well contained, it makes sense for monetary policy to stay focused on its price stability objectives. And financial instability that emerges, whether it's an individual bank or individual financial institutions, can be addressed with financial policies, liquidity facilities or interventions. For instance, in the US, we had the deposit insurance coming in. And that allows monetary policy to remain focused on the price stability objective. If we were to find ourselves, and let me be very clear, we are not in this situation. If we were to find ourselves in a situation of systemic financial crisis, maybe even beyond the adverse scenario that I described to you a minute ago, then it's very clear that objectives of financial stability would take precedence over price stability in the near term. It doesn't mean that you would abandon any nominal anchor, but it means that in the near term, you would have to put financial stability first. Where is that transition where you go from one to the other? it's a bit of a fuzzy area, as you can imagine. And it's one we're exactly trying to sort of think about more carefully. But our assessment at this point is we're not near at all that sort of transition region. So monetary policy needs to stay focused on price stability. There's a very important reason for this, which is that if at this point central banks were to pivot away from price stability, then there is a chance that the fight against inflation would not succeed. Inflation expectations would start rising, inflation would prove even more persistent, and that in itself is also a source of macroeconomic instability, and that would feed even potentially further later on into financial instability as well. So we would not be gaining on any front. So on Russia, we have indeed revised upwards our projection for 2023 to 0.7%. That's an upward revision by 0.4 percentage point. And we've revised downward for 2024 to 1.3%. That's a downward revision by about 0.8 percentage point. So what is our understanding of what's happening with the Russian economy here? Well, one thing we had in 2022, and we're going to get less of it in 23 and possibly into 24, there was a very strong source of revenues for the Russian economy from energy exports. Very, very high energy prices, and that helped support economic activity. In addition to that, there was a very strong fiscal impulse in Russia in 22 and continuing into 2023. But if we look forward, what we see, as you pointed out, oil prices declining. We've seen that the price of the oil sold by Russia in some cases has been substantially marked down compared to other oil indices. And we anticipate that the revenues will actually be coming down. The revenues feed into fiscal revenues as well. So that will make the fiscal situation a little bit more complicated from the point of view of the fiscal authorities. And that goes into some of our projections for 23 and 24. Pierre, let me.
Thank you. Just to add a few thoughts here, it's also important to think about where growth was last year, which was at minus 2.1. So in a way, the recovery that we see this year is partly just the base effect of that. And in addition, we saw a very strong fiscal stimulus, a lot of it related to defense expenditures in the second half of last year. So the impact of that is also expected to carry over this year as well. Now, all of that being said, in the medium term, we're still projecting potential growth to be significantly lower than it was pre-war at about 0.8. And at the same time, the level of output in the medium term, we're expecting it to be lower by 7% altogether. Thanks.
So what we have looked at is the decomposition of the increase in prices, and you can look at it from sort of an income source perspective. And when you do that, this is where you see that the increase in unit labor cost is only part of it, and you have a substantial part of the increase in prices, especially GDP deflator, that's coming more from the corporate side. Now, this is not ascribing motive to why that is an important component. What you have here is a situation where you had a very strong surge in demand. There's a strong aggregate demand component to the surge in inflation that we've seen, and in a context in which there was still limited supply. We had supply disruptions and things like that, especially in goods sectors first, but then services were also affected. Then you have sort of a natural response of the economic system is that prices will rise to adjust. Wages tend to take some time to adjust because they are typically adjusted less frequently than prices, and so that's why we anticipate that we're going to have some of this catch up going forward. Yes, I mean, we had in the context of Japan, and I will then turn it over to my colleague Daniel over here. But we had a relatively disappointing last quarter of the year, and so we have a downward revision both for 2022 to 1%, and there's a carryover to 2023 in the context of relatively weak investment. So this, I think, is one of the drivers of the numbers, the revision in numbers that we have. But Daniel, over to you.
Thank you. Yes, as you said, the last quarter of 2022 was more disappointing, especially on private investment. There was some uncertainty connected with the volatility of the yen, and that has a knock-on effect also on 2023, which is why there's a downward revision there. At the same time, if you look at the forecast of growth, it's going up for Japan from 1% in 2022 to 1.3% in 2023, and this reflects the supportive monetary policy in particular. The inflation rate is also starting to go up, but it's very low by international standards. And that's why there is still this monetary policy support, which we support as well.
So on the UK, first on the financial part, the brief instability in the gilt market, it's certainly the case that there was forceful action by the Bank of England, and that was able to calm the markets very quickly. I mean, it's one of the episodes we've had of this rapid increase in interest rates, creating some pockets of vulnerabilities in the financial sector. In that case, in vehicles that were associated with UK pensions. So certainly, as we've seen also in the U.S., forceful action from financial and monetary authorities was very decisive here. On the UK numbers, let me point out that first, we've had a stronger first quarter of the year in the UK, and in fact, we've had an upwards revision to our projections for 2023. It's still negative 0.3%, but it's an upward revision by about 0.3 percentage points. So we are seeing a little bit better performance for the UK economy. There is a slightly less fiscal contraction in the pipeline as we interpret it, but at the same time there is also the effect of tighter financial conditions, which we expect to see playing out in a number of countries. Now, some of the reasons why, in terms of levels, the UK economy seems to be doing a little bit worse than some other comparable economies have not been different from our previous analysis, which is basically there is a higher dependence on imported energy with a high share of gas, and with the gas prices we've had last year, that's a major negative terms of trade shock. It's a fairly tight labor market, and so there's been a need for fairly aggressive tightening of monetary policy, and there is some effect, already some signs of the transmission of this monetary policy to the broader economy. Yes, well, Eric, you're absolutely right to point out that there are a number of countries out there who are facing very, very severe and difficult situations, especially when it comes to sovereign debt. That's something that has started already last year when we had the strengthening of the U.S. dollar. That was associated also with lots of movements in capital flows and an increase in spreads. That was not uniform. It's not been a broad sell-off of emerging and low-income countries, but it's been quite differentiated. But with some countries facing a very difficult situation, and so we're estimating that at this point we have about still 60% of low-income countries that are in debt distress or a high risk of debt distress, and about 25% of emerging market economies are also at high risk and facing sort of default like type of spreads. And so that's a situation that requires action, of course. There is limited, in some cases, there are limited levers at the level of the countries because they have, by definition, they have almost no fiscal space. And so some of these require starting discussions with creditors, maybe to think about how to reprofile or how to adjust the debt trajectory going forward. Of course, the fund is involved in many of these discussions, and we have various vehicles to try to facilitate these kind of discussions. For instance, the common framework, which has been in place since 2020, has not yet been widely adopted or widely helpful, but is already starting to bear fruit. I mean, we've had one case that was completed under the common framework, that was Chad, and then we have discussions that are underway, taking quite a bit of time, but there is some progress in the case of Zambia, and then there is Ethiopia and Ghana that are also under discussions under the common framework.
So we have a growth rate for India, which is 6.8 in 2022. Let's not forget, this is one of the bright spots in the global economy right now, such a high growth rate. And it is moderating down to 5.9 with a minus 0.2 revision compared to January. What's happening here is also a set of historical revisions. We realized that 2020, 2021 has been actually a lot better than we thought. And so actually there's less room for catching up. And that pent-up demand, which from consumption that was informing our previous forecast is therefore going to be less because they've already had more catching up before. So that's why there's the downward revision this year. Then we go up to 6.3 next year. Again, a very strong economy, which is necessary to allow India to continue to converge towards higher living standards and create those jobs that are necessary.
First, on Argentina, the reason for the large downward revision of output for 2023 is very, very clear. It's the drought. It's a massive drought, and it's having a huge impact on the economy. It's expected to be transitory, so we're revising downward Argentina's growth rates for 2023, but 2024 is expected to be at 2%, which is sort of more or less on average. On the inflation front, we had seen some progress, but of course, the recent economic challenges have actually led us to revise upwards our inflation numbers for Argentina. So yes, it's 88%, but it's up from before that. In January, we're expecting to be coming down to 60%. So it's coming down a lot less. But let me turn it over to Pierre.
Yeah, just maybe a couple of other thoughts. So we saw in when it comes to growth, we saw a fairly sharp slowdown in the last quarter of 2022. So some of that impact is expected to carry through this year, and of course the impact of the drought is the reason for the significant downgrade of growth for this year. So when it comes to inflation, inflation ended the year last year at 94.8%, which was a very large number, and we also saw a pickup in January, although part of that was because of the food prices. So the underlying inflation pressures are still there, and part of that is because of the unanchored inflation expectations. So the way I would characterize our projection is that we are actually expecting inflation to stay high, and to stay at very high levels, although which actually prompts the question of what has to be done, and this is where the importance of macroeconomic policies, having tight monetary policy, as well as fiscal policy, which is in line with what is in the fund-supported program, would be particularly important.
All right, welcome back. I hope that you saw, the presentation and you were able to take away some things from that presentation. Nigerian policymakers were here. Earlier on, also the G24 held a meeting, and the G24 it's an intergovernmental group where we have, of course, the finance ministers as well as the central bank governors of 24 countries. Out of those 24 countries, we have 11 African countries as members, and Nigeria is one of the member of G24. We have Nigeria, we have South Africa, we have Algeria, we have Ghana, which one again? We have Morocco, we have Haiti. Of course, Haiti is not an African country. We have Trinidad and Tobago. These are some of the countries that make up the G24 group. And they did have their meeting, and at the end of the meeting, part of the outcomes which were discussed with journalists was that they did talk about taxation. They did talk about the commonality of some of the issues that they were facing, and urged the IMF for more support, urged the World Bank for more support. So these are some of the things that have happened here today. Our central bank governor, Godwin Emefiele, did attend with the Minister of Finance, Zainab Ahmed. They were present in that G24 meeting. All right, that's the much we can take on today's edition of the program. It's really a wrap. And I can't wait, to take off this jacket and go relax, because whenever the IMF World Bank spring meetings come up, it's really a very busy one here. So many meetings to attend, so many conversations to listen to, where you have the global leaders, where you have shapers and movers of the world economy. But that's the much we can take on today's edition of the program. Trust us to keep you up to speed with everything happening with the 2023 IMF World Bank spring meetings. I am Nancy Naji. Be the best you can be, and be the change that you want to see. I will see you all again next time.